entitled Seizing Central Bank Assets. The rules of engagement are the following. Massimo, you have 40 to 45 minutes. Then there's going to be a discussion, a formal discussion for about 15 to 20 minutes. And for those who want to stay a little bit longer, we'll stay online until 6:15 Central European time. If ever you have questions, please ask only clarification questions in the Q&A during the presentation, and then afterwards we can get more into the content of the paper. So Massimo, the floor is yours.
Let me share my slides now. And let me put them full screen. So thank you very much for having us today. It's a pleasure to present this work. It is joint work with Tobias, who is at the fund now, used to be a colleague at ECB, and Arnaud and Isabel, who also work at the ECB. Considering our affiliation and the topic, the usual disclaimer applies, but I will read it in full. So the view expressed here are those of the authors, and they obviously do not represent the view of the ECB, the Eurosystem, or the IMF. This paper, as you can see from the title, is about seizing central bank assets. And for those of you who might have seen the CEPR paper, it has an empirical part, which relies very much on a new historical database, and a model part. And the presentation today will be mostly on the macro history part, with a bit of the SG plumbing at the end, of which I am the expert between these authors. So I apologize in advance if my exposition of historical data is a bit underwhelming. So, but let's start with the introduction and with a clear view on why we are doing this. As you know, there was, when after the Russian invasion of Ukraine, a huge debate on freezing central bank assets. You might know that there are quite a pool of assets owned by the Russian central bank that are actually frozen by the G7 and their allies, most of which are denominated in euro, but not all of them. And over the months following the invasion, the question has arisen on what to do with these assets. And some discussions, some people in policy circles and in the public opinion have suggested to not only freeze this asset, but to fully confiscate them and move the proceedings to sustain Ukraine. This has been publicly debated in the press. These are two articles from The Economist. And for this reason, we start working on trying to understand what are the macroeconomic implication of this move and whether this move has been actually ever done before in history. And if you look back in history, you realize that most of the question and then the discussion that we had over the last years about the implication of seizing or freezing central bank assets for the role of international currencies, in particular the dollar and the euro, and the role of specific country like the US as a attractor of foreign investment are not new. This picture here on the left and the statement is about a discussion that took place in the US at the end of the 80s about what to do with frozen assets that they hold, and the question that was discussed at the time is very much similar to what is being discussed now. So what is the impact of this move on the attractiveness of the United States as a location for investing foreign capital? But you can go even further back in time. If you look back at what happened during World War I, before the United States entered the world, you know that the US took steps to freeze some of the assets of the Axis powers. And back then, and here we are talking about events in the early 30s, so before the development before the attack at Pearl Harbor, you see that the US government was already concerned by the increase by the expansion in the demand of gold and the potential lower demand for US debt. And if you follow the debate, this should resonate a lot with what was discussed just a few years ago. So we decided to start to look at this episode in a more systematic way. And we compiled a data set with all, or at least to our knowledge, all events that involve a freeze or seize of central bank assets since 1914. And then we use this to compare it with what was proposed to do and what has been done to Russia today. And as I will show in a few slides, the scale of the frozen assets, of the Russian frozen assets, is unprecedented in history if you look at period outside World War. And we then try to put the knowledge, the insights that we got from looking at historical data into a standard multi-country model, and to look at what are the implications of freezing or seizing central bank assets. And we try to understand what is the macroeconomic mechanism. And the main conclusion of the model is that, of course, there are general equilibrium effects. So the freezing of assets by central bank, if they are sufficiently large, have an impact on global interest rate and the exchange rate, and that can feed back into the sanctioning countries. When we calibrate the model to today Russia, we see that seizing these assets, and I want to stress seizing, a measure that has not been done yet, could lead to an increase in the sanctioning countries' yields that goes, depending on the model calibration, between 20 and 60 basis points. And this could potentially lead to a higher cost of debt that will exceed the value of seized asset into few years. There is a literature, of course, on this, and there is a literature on sanction, which is mostly focused on financial sanctions and on the post-war period, on trade sanction and the post-war period. There is we work on a paper with Barry Eichengreen last year. There is a seminal book by Mulder, which was very much instrumental for this work. There is a conceptual framework on how sanctions work, including financial sanctions, but these are mostly related to private assets. While here we really look at what happens if you freeze the assets owned by the central banks. Before going on, I think it is important to clarify one definition. So what is the difference between seizing and freezing? Seizing assets means a transfer of property. So the assets are not property anymore of the central bank who own them. They are expropriated and they are permanently transferred to another entity. While freezing is instead a temporary move. The sanctioned central bank cannot use those assets for a certain amount of time, but at the end of this period, the assets go back to the balance sheet of the sanctioned central bank. So how do we construct a data set? We use a wide variety of sources, primary, secondary sources, and we include current contemporary newspaper and journal article, but also scholarly accounts. And we focus on the period between 1914 and 2024. We collect a bit more than 100 cases of sanction to central bank assets. And for each episode, we have collected the characteristics. So we know which type of sanction it is, if it is a freeze or a seize, which country is targeted, and which country are imposing the sanction. It could be possibly more than one. For each episode, we have a small monography that recollects what was happening, what was the legal basis for it, and why it was imposed. We also add the beneficiaries, if there were, and for how long the measure was imposed. This is all collected in a dataset, but at the end of the paper, you also have a very extremely long appendix documenting each case in detail. So if you're interested, you can go there and read the details of each cases. Once you have this wealth of data, of course, you want to look at them. So the first thing we do is that we plot the share of total central bank assets that were targeted by sanction per year. This chart shows new measures. So this is not cumulative. These are new measures each year. And you have on the right-hand side the amount of assets excluding precautionary measure. On the left-hand side, you have the amount of assets per year including precautionary measure. And here you can already see a couple of stylized facts. The red bar is the case of Russia. And you see that this has hard any precedent for size in the period after World War II. The only comparison in size in magnitude in this period is the big spike you see in 1979, which is the sanction of Iran asset by the US. But other than that, any other comparable episode took place during a world war. The second thing that we can look at is the size of the countries that are target of this measure. The red bar is again Russia. We stand at about 3% of global GDP in 2022. The other two bars are the median size of country targeted by sanctions in the period before 1945 and in the post-World War II period. And as you see, again, hardly Russia really stands out as a target of sanction compared to the recent history. But even, if you will, compared to the pre-World War II history, of course, this is also reflecting the fact that there were big countries involved into the war, the UK, Germany, France, but also many small countries that got involved. And of course, this affects the average. And if you look at the scale relative to total reserves, again, the case of today of Central Bank of Russia really stands out. And this just to make the point that not only what has happened in 2022 is unprecedented in recent history, but that really looking at the history in the post-war period is probably not the best source of regularities if one wants to understand what are the macroeconomic implications of sanctions to central bank assets. So we really need to make an effort and try to extend our sample to the pre-war period, so go back to history, in order to try to tease out what are the effects of sanction on large economies that have an important role in global trade, for example. Again, here, just to make it visual, this is a map of countries targeted by sanctions in the post-World War II period, and you really see how Russia stands out as share of GDP. And probably the second largest country is probably Argentina, while the others have a much lower share of global GDP. But there is also another important lesson that we can learn through history, and it is what type of sanction have been imposed. The dataset, as I say, can slice sanction in many different dimensions. Today, I present just one. And I want to make the difference between freezing and seizing episodes. This is the gray area is seizing, and the dark gray area is freezing. As you know, as you can see from the first chart on the top left, freezes constitute the vast majority of sanctions in the dataset. But the other important thing is that there are no recorded episodes in history when countries that were not involved in a bilateral dispute seized the asset of central banks outside a war. And this is the chart on the lower left side of this graph. So really, the proposal of seizing asset by the Russian central bank from the G7 is actually absolutely unprecedented. We couldn't document any episode in history when something like that has happened. And once you have this wealth of data, you also want to try to disentangle some empirical facts. Also, in this case, we need to rely on historical data to really leverage on the sample that we have that goes back to 1914. Because of this, our empirical estimate will also be very much biased towards that period of time, as most, not only most, but also the largest sanction episode took place before the end of World War II. How we do this? Well, we use the ubiquitous framework of local projection. When we try to compute in a panel setting the reaction of a target variable, and I will show which variable we use on the left-hand side in the next slide, against a number of control and the imposition of bilateral sanctions, or of sanctions to central bank assets. We control for fixed effect at the country level. We can control for the external default dummy from Mehl and Rogolf. We use the historical geopolitical risk index to proxy for geopolitical development, and we also control for trade sanction, leveraging on the on the data set we developed in the previous paper I mentioned at the beginning of the presentation. Our key variables is this dummy sanction, which measures the imposition of sanction of central bank assets on country I. We cannot distinguish between freeze and seize, as you know, we will be left with too few observations. But we can gather some stylized fact out of this exercise. And we on the right-hand side, on the left-hand side of this equation, we have a couple of interesting variables. So first of all, we look at the exchange rate between the country targeted by the sanction and the dollar. And this is the first panel on the top left of this chart. And you see that historically, country targeted by central bank sanction tended to depreciate against the dollar. Then we look at inflation in the sanctioned countries, and we show that historically, inflation tend to increase. This is, robust to controlling for fixed effect, and is also robust for excluding, for example, Germany from the sample. Then we look at real GDP in the country targeted by the sanction, and you see that there is a clear fall in GDP. And remember that this is controlling for default, for external default, but is also controlling for geopolitical risk, which absorbs, we are in a yearly setting, also the effects of wars. Then we turn to the gold price. Why the gold price? Well, because in the pre-World War II period, most central bank assets that were sanctioned was actually gold. They were not bond. So we want to see what is the impact on the gold market. And as you see here, there is a clear increase in the price of gold. We take the value in pounds because we use the dollar value, we use the dollar exchange rate before, so we kind of want to try to net out the effect of the movement against the dollar. Finally, we look at what happens at the sanctioning country. So we change the definition of the regressor, and instead of having sanction a dummy equal 1, if a country is a target of a sanction, we have a dummy equal 1 if the country is imposing a sanction against another economy. And in this case, we have a downward movement in inflation, albeit not particularly statistically significant, and a slight increase in GDP. Also here, not particularly statistically significant, and reverting back after a few years to the pre-sanction level. So this is what we can learn from history. But then, as I said, we try to put very hard to put this insight into a theoretical framework. And here we took a multi-country model. We have 3 countries. Why 3 countries? Because we need one currency area that imposes sanction. We need one currency area that receives sanctions. And it's important to have one currency area that is neutral. This is not only important for yields, but and currencies, but it's also important for trade, because you can imagine a situation where the sanction imposing country maybe wants to the sanction imposing country also impose trade sanctions, and the sanctioned country wants to divert trade away from the sanctioning group. It's a standard multi-country model with 3 blocks, but we need to include some deviation, departure for the standard multi-country framework that you have in mind. I spare you, the DSG plumbing, so all the equations are in the appendix or in the paper. If you want to get into details, I can do it later on. But we expand it across 5 dimensions. First, we include a convenience yield. So we assume that the asset that is used by central banks as a reserve is also giving a convenience yield to households in all 3 economies. And this is kind of the idea behind the dollar, that you don't hold dollar assets only because you want to invest in that specific security, but because also those assets are very convenient to use for many purposes. For example, they facilitate your access to trade, or they allow you to do particular financial transactions. Second, of course, because we want to deal with asset sanction to the asset owned by the central bank, we need to allow central banks in the model to have an active balance sheet where they have assets and liabilities, and we need to impose sanction on these assets. And the central bank balance sheet will be clearly in a slide, but in a very simple way, assume that the central bank issued the currency. Think of this as M1, and back these currencies by either domestic asset, gold, or foreign assets. We need, for having meaningful effects, that quantity cannot adjust freely. So gold is in fixed supply, and you can think of this as the amount of gold that can be mined every year is fixed. So you cannot increase the supply of gold in a given year beyond that. If you need more gold, someone needs to sell it. Some central bank needs to sell it. And also we need to have an active central bank government budget. This means that the assets in circulation of each country are emitted by the government in each country to close its budget, so to match expenditure with source of financial sources. This is an important implication, because imagine that you want to shut off one country, one central bank, from trading in bonds of one country, say the US. Well, if the US still emits the same amount of debt to finance its budget, this debt needs to be allocated somehow. And to convince other agents to buy more US debt, well, the price needs to fall, and then the interest rate needs to increase. And then we need to model explicit sanctions. And how sanctions are modeled is an expropriation of asset held by the targeted central bank. And this expropriation can be temporary, which means that within the expropriation, there is in the model the implicit commitment to give back the asset after a certain amount of time. This is a freeze, or permanent. And in this case, the central bank loses completely those assets. They're written off from the balance sheet, and their value is transferred to another country. This is permanent, and this is a seizure. So before going on to the simulation and the impulse response, let me give you an intuition on why I think it's important to have a model, and to have a model that can account in a structural way and coherent way about general equilibrium effects. This is the stylized central bank balance sheet that I just described. What happens if sanctions are imposed? Well, imagine someone takes away some of the foreign bonds, the green area here. Well, what happens is that the central bank can either decrease money supply or accept inflation. assume that that is a central bank that is very much against inflation. So it wants to decrease money supply by the same amount while money needs to go down. But if you think at a partial equilibrium story, this is the end of it. But if you think in general equilibrium, things become more complicated. What happens if you take away these assets? Well, the currency, we have just seen it, in which these assets are denominated, appreciates, at least bilaterally, against the target country. But if the currency appreciates, well, you have valuation effects in the bonds that are left to you, but also in gold, because gold is denominated in dollars. So if the price of dollar goes up, the value of gold also goes up. And this partially balances out the initial effect of the bond seize or freeze. But the thing can get even more complicated, because imagine that again, I just make the example of the US. The dollar appreciate, trade for the US worsen a little bit. In this model, the exchange rate is a strong driver of trade flows, generate a small recession, probably inflation goes down. Well, then there is a Taylor rule in the model. The central bank of the targeted country doesn't like domestic deflation, doesn't like a domestic recession. It cuts the interest rate. But if the domestic interest rate goes down, then the price of bond goes up, and that also partially counters the effect of the sanction. So just to say, there are a lot of general equilibrium effect that can work in these models, and one needs to take into account if he wants to think about the real macroeconomic impact of sanctions to central bank assets. And this is the exercise we're trying to do here. In the next couple of slides, I will show you the effect of a seizure, so a permanent expropriation of bonds from the US, one of the three countries in this model, on a targeted countries that we call S is the sanctioned countries. And we denominate rest of the world the remaining country in the model. So we will always have this free line. The gray line is the sanctioning countries, the US. The black line is the sanctioned countries, and the dotted line is the rest of the world. This is a very simple calibration of the model. We assume that 1% of the asset owned by S are taken away permanently. We also assume that all countries have the same size. So, the spillback effect of the sanctioning economy and on the rest of the world are kind of maximized. And we are also shy away in this simulation from thinking about seizing gold, which is the prevalent case in the historical episode, and for freezes. And I do this, it's in the paper, but I had to make a choice, not to what you show. So I show you this, that is the simplest exercise to explain, and you can think of the other exercises as a complication or a perturbation of this one. So let's start off with the impact of sanction on the sanctioned economy. So money supply goes down in S, but not by as much as one would expected compared to the amount of bond reserves that are frozen, that are seized. This is exactly because there are general equilibrium effects. And you see the general equilibrium effect in the reaction of the exchange rate, which is the variable in the second panel from the left of the last row. The dollar appreciates relative to the target country. This, of course, sustains the value of asset held by the targeted central bank. Nevertheless, you have a tightening of financial condition in the sanctioned economy. You see this from the increase of the convenience yield in the sanctioned country. So, US bonds become more scarce, and that brings up their value in terms of, for households. But also you see it in the increase in the risk-free rate, which is a measure, of the financial condition in the targeted economy. What you also notice is that there are spillover to other countries and currencies. First off, the currency of S depreciates against the rest of the world, and also the US dollar depreciates against the rest of the world currency. If you look at the macro implications, so on real variables, you see that first off, as I mentioned, if you look at inflation, the last variable in the middle row, you see that the domestic central bank in the targeted countries accept a bit of inflation. So part of the sanctions are mitigated by the appreciation of the dollar. Part of the sanction result in a tightening of financial condition. Money supply goes down, and part of the sanction are eaten up by inflation. The central bank accepts a bit of inflation as a result of the sanction. If you look at real variable, consumption and investment, they fall in the target countries. They have a small movement in the issuing country, while the rest of the world, who stays a bit on the sides of it, enjoys an increase in consumption and investment. The puzzling part, which is departing from the evidence we saw from the historical episode, is the reaction of total output. You saw the total output stay constant in the US, while increase in the country targeted by sanction. And this increase is entirely driven not by development in the domestic production, this falls. This is the second chart in the top panel from the left, but is driven by exports. In this simulation, we do not prevent the targeted countries to export to other economies, and we know that the target central bank, that the target country currency depreciates both against the US and the rest of the world. This means that export will increase, and it actually compensates for the fall in domestic consumption and investment. This means that, obviously welfare for households in the targeted economy goes down, but nevertheless, production can stay up, driven by exports. This is very different from what was the case in the pre-World War II period, where trade relative to domestic consumption was significantly smaller than what implied and calibrated in this model. The last bit of impulse response that I want you to show is the one on utility, and you can think of the integral of this as welfare. As I anticipated, utility for the targeted country falls. That's quite consequential from the tightening of financial condition, the decrease in consumption, domestic household are worse off. Opposite is true for the third country, which enjoy an increase in consumption. But notice that utility falls also in the US. And this is due to the small contraction in US output, consumption, and investment that is essentially due to the fall in export of the US to country S, and to the appreciation of the dollar in bilateral terms. We now try to make a last exercise, that is to take instead the model a bit more serious, and instead of looking at 3 countries, at 3 countries at random, we try to calibrate it as much as possible to the case of today, Russia. We need to adjust the model in several ways. So first of all, we calibrate country shares, looking at share of nominal output in 2022. We calibrate the G7 group, which is the group of countries that impose sanctions, to 52%, Russia at 2%, rest of the world 36%, the residual part. We try to calibrate the share of Russia foreign reserves as 20% gold and 80% asset by the US or the G7. We don't know, of course, this number with certainty, but we can rely on the latest available report of Central Bank of Russia to try to get a rough a rough idea. And then we estimate with moment matching 12 structural parameters, looking at using data from inflation, GDP, money supply, and interest rate for the G7 and Russia. So we shy away from using data from rest of the world. We concentrate on these two countries. And in particularly, we try to match classic parameters that you want to match in international macro, that are the coefficient on the Taylor rule, the price stickiness, and the elasticity of substitution across goods. What you would expect, of course, is that being Russia a much smaller share of the world, the effect of the shock should be smaller. However, notice that instead of simulating 1%, we need to simulate a 50% freeze of Bank of Russia reserves. This is achieved solving the model non-linearly, because of course we move very much away from the deterministic steady state, so we cannot rely on perturbation methods. We need to embrace the non-linearity. And when you do that, you have, of course, a graph that is much less good looking, as you would expect, because you really go non-linear in the simulation. We simulate a seize of 50% of Central Bank of Russia assets, and we also prevent Central Bank of Russia to enter the markets for 30 periods, which the model is quarterly, so this is about 10 years. So after 10 years, it can re-enter, it can buy again bonds from the targeted group. Sorry, this is not US, this is the G7. What you see is more or less in line with what you would expect from the previous exercise. You see money supply that falls in the target country in Russia. It falls more in the group of sanctioning countries, and this is due to the move of private households into bonds in the long term, and to the reaction of the central bank, the endogenous reaction of the central bank. You also have gold reserves that shoot up. The targeted central bank tries to move out of bonds and into alternative reserve assets. In this model, there is only one alternative reserve asset, that is gold. So this, of course, increase. Notice that this is not ideal from a reserve management perspective. So as soon as the targeted central bank is free to access bond markets again, it tries to liquidate gold reserves. But interestingly, and this is what I want to show here, you have interest rates in the targeting country group, the gray line, that shoot up quite a bit. In this calibration of the model, they reach about 25 basis points above the pre-target level. And this is the implicit cost of putting sanction of central bank assets. What happens is that one key player is excluded from the market. And because this player is excluded from the market and those assets are frozen, the targeted group of country needs to place the remaining bonds to other investors. And of course, to do so, it needs to lower the price, and the remuneration needs to increase. This also increase the movement in the exchange rate. So the sanctioning currencies appreciate by more, and of course this is this also shows up in output. And if I were to show you the picture with output, you would have you would see also quite some effect, that despite the targeted country is really small in the global economy. Let me move to the conclusion. So what we've learned from history is that the current freeze of Russia's central bank asset is really thin and is not comparable to previous episodes, there are no precedents of seizing central bank assets under this condition in history. This model simulation, they show that seizing central bank assets have stronger effect than freezing. This is due to the fact that when there is a freezing, as I anticipated, there is the implicit promise of giving back the asset at some point in the future. So those impulse responses that I have in the appendix, they have pretty much the same shape, but they're smaller in magnitude because agents in the model anticipate already that the asset will be given back. And you know that this in these dynamic general equilibrium models, these anticipation effects can be quite strong. Those of you who are familiar with the forward guidance puzzles know very well what I mean. But importantly, independently on the asset that are freeze or seized, and on the type of asset are considered, we have also simulation for seizing gold. Of course, there the dynamics are partially different because there is a price of gold that adjusts and there is a limited global supply of golds. However, golds can be sold by central banks, so there are some interesting dynamics going on in the rest of the world that I'm not discussing here. But these have a cost for the sanctioning country. That is that this country needs to be willing to pay to impose international sanctions. And this cost goes to appreciation of the currency and an increase in yields. Policy implications are clear. This is sizing central bank asset is not just an incremental step relative to freezing, but a much stronger economic implication and much stronger political implication, and has never been done before in time of peace between two nations. And of course, in today's Russia, this will lead to an increase in interest rate payment, which could carve out the value of the seized asset after about 2 years in this calibration of the model. Thank you. And this is all. I give back the floor to the chair.
Thank you very much, Massimo, for an interesting presentation and excellent timekeeping. There is already one question in the Q&A. Eugene White wants to know whether the seizure of Russian central bank assets is similar to the old post-World War I transfer problem that was raised by German reparation payments.
Okay. So, hello, Eugene. If I answer directly this question?
Yeah, please go ahead.
So there is a monograph at the end of the paper, which is on the CEPR. Of course, unfortunately, this is a bit let's say a first version of the paper. We made few improvements, especially after the conference where we have been in Sweden. But it's not exactly the same thing. Because the issue about seizing is transferring immediately the property away from the country that owns it, liquidating this asset, so there is nothing to give back at the end. The asset has been liquidated, they're gone. And this value is, this amount of dollars or gold is given from someone else. And we assume in the model that is used to finance consumption and production. This, in my reading, is different from the problem from the discussion that you cited, and is also very much different from other episodes of partial transfer of properties that have happened in the past. Just to complement, there is another question that is often raised when we discuss this, is about the case of the Polish gold during World War II. This is for non-macro history specialists, this is a bit confusing. That was not a case of seizure; it was a freeze. The gold was actually transferred back after a few years. I probably don't need to go too much into the details for this audience.
Excellent, thank you. Eugene, would you like to add something to that? Would you want me to unmute you? We'll take this as a no. There's another question by Carla Frenzel. Carla would like to know whether in the simulation you allowed other assets to achieve reserve currency status.
Okay, this is a very good question. Yes and no. In the sense, it's not in what I show you, but it is in the new version of the paper, and they have this in the appendix. In this case, in the baseline simulation, we assume that there are two reserve assets. One is the asset issued by the sanctioning economy, and the other one is gold. So if you want to move away from the sanctioning country, you need to move into gold. But of course, a very good question is whether other countries might become reserve currencies. No, if because of sanctions, then the sanctioned country will start buying assets from the rest of the world, for example, as protection against the potential, reiteration of the measures. We allow this in one extension of the paper. And what happens here is something very interesting, that there are costs for the country that becomes reserve currency. And these costs are through the exchange rate. If there is more demand for bonds issued by the rest of the world, the currency of the rest of the world needs to appreciate, and this is detrimental for trade. You can spin this into the current debate and the current configuration of the international monetary system, and you can make your own conclusion whether large countries that are not now issuer of a reserve currency would really like this scenario to materialize. But the takeaway from the paper and from the model is that there are no free lunches. So there are very strong general equilibrium effects that eventually with time they kick in, and they generate costs for all countries that are involved, and they see a change in the demand for their assets.
Thank you. There are no other questions for now in the Q&A, but I do have a few questions, if I may. So if I understand, your finding that there's no free lunch depends very much on the fact that because there's a depreciation in exchange rate, sanctioned countries export more. What happens if the sanctioning countries not only seize central bank assets, but also impose sanctions on trade flows?
So that's very good question. This is an extension that we had in one of these one of the exercises that we do. So we also impose trade restrictions in a way very similar that is done, for example, in the paper by Fabio Gironi. And what you see there is that clearly the recessionary effect for the target country, for the target country targeted by sanctions, are much stronger because it cannot export its way out. However, cost for the sanctioning country remain. Why? Because there is a decrease still. So the cost of the sanction arise from two channels, actually. One is the trade, but the other one is the financial channel. If one country in this world economy is forbidden to trade assets by the reserve currency issuer, but the reserve currency issuer wants to maintain the same size of its budget, of its government budget, so the same supply of bonds, well, these bonds need to be placed somewhere. And because the model economy is closed, the only way to convince other agents in the model to buy more of those assets is to decrease the price and increase the rates. So this has two implications. So one is a bit of tightening of financial condition in the countries that issues global debt. Consequence number two, well, there are real implications through trade because the exchange rate still appreciates, so trade between this country and the rest of the world changes. But also the debt becomes heavier to finance, and because the debt becomes heavier to finance, there is a slight decrease in the capacity and the spending capacity of the government. No, and this of course is part. The economy needs to close. This is a part of aggregate demand. But this is what we find when we do this little game with trade sanctions.
And these two negative effects outweigh the positive effect of seizing the central bank's
Well, if you think this is a bit back of the envelope calculation, no? But if you think how much more you spend to finance your debt, you can you can calculate when you break even. So when you spend exactly the same amount that you have seized from the central bank, and that happens after a few years in the model. The model is a model, no? So parameters matter.
Yeah.
So this depends, there is a window of time depending on the selection of parameters, but this happens within few years.
Okay, thank you. Nathan, you have a question? I see you raised your hand.
Yeah, thank you for a fascinating presentation. I want to go back to a little bit to the data and deviate a little bit from the model. But that relates, of course, to the model in some sense. So first of all, in terms of the stylized balance sheet of the central bank, so basically you balance the accounts. There's no positive or negative capital to the bank, which definitely in the case of the Bank of Russia, they had you have to believe their accounts, but the central bank accounts show a very large, relatively large positive net worth that they could eat into. So that mitigates part of the decline in the liability, especially domestic liabilities. So they can absorb part of it through the capital, but also you can go into negative capital, which is also a possibility, and many countries have these are in these zones for whatever reason. So that's just in terms of another buffer to absorb some of the adverse effects of declining on the asset side. The other thing in the Russian context is this. It's not a balance sheet effect, but it's more of a expectations effect. So you have this, so you seize the assets. There is a run on the reserves in some sense because, or run on the currency because they know the reserves are lower, they cannot defend the currency. So they jack up the interest rates quite substantially. That's what they, I guess, did in Russia. Probably more than like a standard inflation targeting model would apply. In order to stem the outflow of the run on the central bank in some sense. And this itself reduces the demand for money because the interest rates go up, and therefore part of the decline we see in the money and the balance sheet, the monetary base is also compensated for, quote unquote, with a decline in demand for money because of the high interest rate. So there are these channels that I'm not sure are. I guess that those models could be very, and I know it's very difficult already, but just to try to relate it to these historical episodes in terms of this, the ability to absorb through the net worth of central banks, but also the interest rate reaction that could be could have these effects that I described. Yeah.
Yeah, so no, of course, these are very, very valid points, no? So you need to take a stance when you write down the model. So the first thing we said is that we rule off the capital from the central bank balance sheet because we want to be very stylized. In a way, this is a one government structure. So, central bank rebates profit to the government every period, whatever it is, positive or negative. This is a simplistic assumption, no, but it's needed to close this model. And on the on the story of interest rate, I fully agree. No, there is much more. Central Bank of Russia has also capital controls in place. They have not received a seizure of assets. No, they've been so long they've been frozen, and they've stayed there for the time being. We do see a bit of these channels in the background of the model. No? So the stylized error rule, the Euler equation that is there, a bit capture these things in a way that you see quite an increase in the domestic interest rate in Russia, which is, as you say, partially is due from the decreased demand for money, partially is due from the endogenous reaction of the central bank that wants to he needs to increase the interest rate to defend the monetary base. But these are a bit, in this model, you want to capture this in a very tractable way. And that's the thing that we do. To be fairly, when I wrote the model, I was thinking really to the exercise of a very large action, a very large measure. And for this, you must rely on some kind of nonlinear solution, because otherwise that simply doesn't make sense. Of course, the cost for that is that you need to gain simplicity in somewhere if you want the algorithms to converge. But many of these stories are in the transmission. So we don't do the best job, but I think we do a decent job in trying to capture some of this. But very good point.
Yeah, I mean, I understand it adds a lot of complexity, but
of course.
But from the sort of a historical economic history thing, I mean, some of these complexities are quite important in some sense. So
I probably should have chosen the reaction to gold, which are more like what, once you go through the database and you read the historical episode, you realize that most of them work through are seizure or freezer of gold, which we also have, and there things are a little bit different, because of course you can substitute gold with bonds, and you can buy from others that might want to sell if the price goes up enough. So it's probably, but this is also in the paper if you're interested. Does not change much.
Thank you, Massimo. You have another question by Patrick Honohan, which should be able to speak.
Yes, because I've lost the question and answer.
Okay. My question, a little bit prompted by Eugene White's question, trying to ask whether there was a comparison with the transfer problem, and I think you gave a good answer to that. But my question is, in a sense, leading from that, does your model really zoom in on central bank sanctions, sanctioning of central bank monies? Supposing it was a sovereign wealth fund, would that make any difference? Because a lot of the discussion around the Russia case was, we can't seize that central banks. Central banks are sacrosanct. You couldn't possibly touch central bank money. But I sort of think that your model would go through completely if it was a sovereign wealth fund that was being seized. And in a way, therefore, not being a central bank issue as much as a public sector asset seizure.
Okay, so I have to admit, I've not thought of this in the model yet, so I will give you my sensation about it. First, probably, you and this crowd know better than me, but when you look back in history, the distinction between government and central bank was a bit more blurred. So for the legal discussion, I would say that the same applies. No. We are talking about historical episodes of seizing central bank assets, but it's very much similar to say historical episodes of seizing government assets when you think at pre-World War II, or at least this is my reading of the episode. Turning to the sovereign wealth fund, in the model, the key difference will be that if you seize the sovereign wealth fund, well, this needs to be written off as a loss on the government balance sheet. And because the government balance sheet needs to balance, you will have either an increase of debt issuance that someone in the model would buy, or you can think of a way to prevent people from buying it. But assume there is no debt, that will be an immediate drop in consumption from government. And the transmission channel will be mostly through the real side. While on the difference from having it on the central bank in this model is that there you also have the financial effect on the currencies. In this model, the UAP is very strong. So of course, if you generate a domestic recession by slashing government spending, of course, the central bank will need to ease interest rate, the currency will need to depreciate, so on and so forth. But these are like, spillover from the real side to the financial. While if you go from government assets, from central to central bank assets, and you want the balance sheet of the central bank to really balance, then you have this direct financial effect on yields and on exchange rates from the sanctions. This is I think is the main difference. While as much as it concerns the sanctioning countries, that will probably stay similar, because the key problem for the sanctioning countries is, as I discussed before, that you have lost, let's say, one buyer of your debt, and you need to allocate this debt to someone. Hence, you need to make it cheaper, and making it cheaper, you pay more as interest rates. This is, but I will need to think about it more on the key difference, and especially, at least for me, it helps a lot to write it down in terms of models to clarify my thinking.
Thanks.
Thank you very much, Massimo. We're out of time. Before I wish you a really nice evening, let me thank you for a very interesting presentation, a very fruitful discussion, and to those for your attendance. On the 9th of April, there is going to be a panel on the industrial policy and history with Giovanni Federico, Reka Juhas, and Kevin O'Rourke. Please tune in. If you want to stay online, we're going to keep this session open for another 15 minutes so we can discuss formally. With that, I wish you a very pleasant evening.
Let me also thank everyone for attending. Thank you a lot.
This was very interesting.
Thank you.
So, Rui, you want to say something? You raised hand.
Yes, I do. Can you hear me?
Yes.
Yes.
Fantastic. Right. So thanks. This is super interesting and very topical. I mean, couldn't be more. But I was wondering about some variations that would make your model even more complicated. Apologies for that. So first one. So I understand why you need 3 countries, but doesn't this, and I know you calibrated it in your Russian experiment, right? But could you say something about the sensitivity of the results to the size of the country doing the seizing versus the country being seized, right?
Yes, of course.
Looking historically, right? Your historical appendix is essentially the issuer of the reserve currency sanctioning, a bunch of collections of countries, right? So it's never Russia sanctioning the US. It's always the US sanctioning Russia for obvious reasons, because, the US doesn't accumulate Russian assets and so on, right? So this is really a story about the issuer of the reserve currency creating blockages or obstacles to countries that they're not politically pleased with in using their financial markets, right? So
there are cases in there is actually not Russia, but the USSR is one of the sanctioning country, in the sense that it appropriates some gold. Of course, there is Germany, did it a lot in World War II. So there are some. It's not entirely US centric. It is US dominated in a way, but not entirely US centric. Yes. So this we can do. We have done it informally. I don't have a chart in the paper, but we have done it. So of course, the bigger in the model, the bigger is the sanctioned country, the larger are the spillover, because you lose more trade. It becomes proportionally more important in trade as absorbers. The smaller is the sanctioning economy. That is less of let's say a game changer, in the sense that what matters is in the model is not the size of the sanctioning economy, but is the share of assets that this country from these countries in the pool of assets in the reserves. So you can. I make a complete absurd example. Imagine that Switzerland and we hold 80% of reserve in Swiss franc. Even though Switzerland is small, it matters a lot for our reserves.
Yeah, except that will never happen because the
No,
Swiss
of course.
Central Bank will never allow it, right?
Yeah,
I mean,
of
there
course.
is a direct, and this is precisely where I want to get, right? It's not just the size of the economy, it's the high correlation between the size of the sanctioning economy and the use of its currency, right, as reserve currency. Because if you, in a slightly different but much more complicated model where you have two reserve currency issuers, which I guess is also what was asked to you earlier, right? Think of
Yes.
Russia, G7, the rest of the world, bar China, right? Which is precisely what's been happening, right? So in that case, the value, the negative feedback onto the sanctioning economy would be much higher, right? Because now they'll be competing for the issue of their debt with the issuer of the alternative reserve currency. So in a multipolar world, right, the story will be more complicated.
Yes. What we have simulated, no? So I can tell you what comes out of the simulation is that yes, in steady state. So if we start off with a multi reserve currency world, if we move there on the path to get there, this third currency that gets reserve currency status appreciates quite a lot. And because it appreciates a lot, well, problems for trade, especially in these models that, are very sensitive. So trade in these models is very sensitive to the exchange rate. Right. So, and importantly, it appreciates across the board. So even if you complicate the model more with dominant currency pricing, it will probably make it worse, if anything, no?
Exactly. Yeah. So if anything, your results are in the lower bound.
Exactly. Yes.
And if I may just add one, this is just provocative,
Please.
right? This is on the size of those being sanctioned. What prevents the central banks from sterilizing?
From complete. Well, you can sterilize if you want, but then you need to, I guess, accept domestic inflation. No, that's partially what they do. So again, here there is no there is not a game in a pure game theory sense where the central bank decide the best way to act. It's just they have this first order condition that are the optimality reaction. So the central bank implicitly accept inflation, a bit of inflation after the sanctions, because it's optimal relative to skyrocket interest rate to complete kill it. And that's, of course, you can make it more or less. That depends on the preference of the central bank, which are calibrated in this exercise, but you can calibrate them differently. It will work differently, no? So, for example, if you have a central bank that is very tolerant to inflation, that can reach inflation very high, then you can absorb more through that.
Yeah, I know, because you're essentially running the model assuming that the central bank carries on running a Taylor rule.
Yeah, exactly.
Right? When frequently these sanctions are effectively, ways of trying to force the countries into financial autarky at the time that they're probably fighting wars or doing something that, right?
Yes,
where the options of the central bank might not be, or the Monetary Policy Committee might not be the usual ones. Sorry, but Nathan has a question.
Yes, another question related to maybe haven't followed the model very carefully, but so one consequence of freezing assets. So gold is, I think, when you talk about gold, I think it's pretty. I think it's cleaner in many ways. But if you're, say, freezing dollar assets, or for example, the dollar assets. Freezing or even seizing, would that increase sort of the risk premia of the seizing country in the sense that their currency is no longer perceived as a safe reserve in some sense, and because if other central banks hold this, they can be subject to these things in the future. So all this exorbitant privilege of the US dollar, etc., might suffer. And I'm here in the back of my mind, it's not the same situation, of course. It was done for a completely different reason, but freezing of the sterling assets after the Second World War in the early 50s, which I think some time to the decline of the sterling as a reserve currency, or definitely correlated with the decline of the reserve. It was for a different reason, but it's of course.
So there are. So what you have in mind, and what I would ideally have to answer this question is, let's say, a Markov switching models when there are regimes. Like there is a regime where you have only the US as issuer of dollar of reserves, and there is another regime where there is the US and someone else. And the probability of moving between these two regimes is a function of having sanctions. This we cannot do. But what we cannot do, what we can do, and this is one of the reasons why we embark in this exercise with the third country becoming reserve currency issuer, is to look at the what happens if you move away, if because of the sanction you start investing in a third currency. What happens there is that the convenience yield on dollar asset goes down. Now, this convenience yield is an endogenous part of the model. It tells you how much lower remuneration, ceteris paribus, households are willing to accept on the dollar to have a dollar asset. The flip image is that this allows the US government to run a much higher debt with the same cost because they pay less on the interest on the bonds that they should. This is endogenous in the model. And this thing shrinks after people start to investing in the third asset. So this is kind of, once you write down the model and you see what happens, I've done my fair share of plumbing and it's okay, but I should have expected this. But of course, the story is a bit the one you have in mind. That there is a declining global demand, and people demand less, and of course yields and price need to adjust. It's a bit stylized, but we have thought a lot whether we should try to do this extra step, but the complexity is significantly higher.
Thank you.
Thank you, Massimo. If there are no other follow-up questions, I think we can close this session. This is really interesting. Again, thank you very much.
Thank you. No, thank you a lot for having us. It was a great pleasure.
Thanks.
Thank you.
Yeah, come again. Right.
As soon as we are, doing this type of historical work is, for us, it's very hard because it requires a lot of time. But we try, So we have some things on this. We will see if we manage again to write a paper.
All right.
Thank you.
Great. All right.
Thank you.
Bye.
Have a nice evening, everybody.
Bye.
Bye-bye.
Bye.